Hi everyone, welcome back to my Diploma series. We're into part 2 today, so we're going to look at some high-level metrics, and I already talked about a red flag in the previous episode, and we might uncover another one today. So let's jump into the metrics first. So here on the screen, you can see the revenue growth, and it's been growing at sort of that 12%, 13% number prior to the big COVID boost. It's actually 15% per annum over the last 10 years, but yeah, it's better to call that about 12%. Oh, and before I forget, Diploma PLC is listed in England, so you're going to need a broker that can access the England market. Interactive Brokers is the one that I use. There's a link in the description for that. And if you were to want to invest in Diploma, which is track record wise has been a phenomenal business, Interactive Brokers would be the way to go. Okay, now with that being said, let me jump back into the business. So the next metric I like to look at are just the margins of the business, and their net operating and net profit margin has been stable for the last 10 years, which is good to see. Net profit margin sitting at about 10%. That's not that high, but they are distributors, so it's probably about fair. If they can hold that 10%, that's plenty of profit margin for them, and it's going to hinder competition coming in because they're already the lowest cost provider, most likely, with the biggest range. So margins are stable. That's good to see. Then the next thing I like to look at is return on invested capital, and this has been sitting in about the mid-teens for the last decade, which is really solid. And I want to see them employing more than their free cash flow into acquisitions, which they have been, which is great to see as well. So since they are deploying even more money than they have, and the return on invested capital being in the mid-teens, it means that we should expect this type of return moving forward if we pay a fair price for the company. Return on invested capital might come down a bit with those bigger deals that they've been paying. So that is a concern that I have. That's something that makes me a little nervous, I guess. Next, I want to look at debt. And in their presentation, they said they have 1.4 times debt to EBITDA. It's actually a little bit higher than that right now. It's about 1.9 times debt to EBIT minus their CapEx. So it's essentially the same thing. So 1.9 times is their debt ratio at the moment, which is getting close to 2, which is 2 is sort of where I sort of draw the line and think anything over 2 is getting a bit over levered. They're definitely pushing the debt a little bit more at the moment. There's probably been some deals on the table, and I think that's exactly what's happened. Regarding free cash flow, we saw that their conversion rates in the previous episode are about 90%, which is great. And that's been growing at around about 11% per annum prior to the pandemic, at their free cash flow number, that is. Next is shares outstanding. And this is where the change has happened in the business of late. Prior to 2019, there was essentially no dilution. They had 113 million shares, and now they've jumped up to 124, and they're going to jump up again into about 133 million. They're using shares as part of the deal to raise money to go out and buy more, do more acquisitions. I've told you what I thought about that in the previous episode. I don't really like it. It can be done well, but it also can be done poorly. Time's going to tell on that one a little bit, but that would be, I would say, something to keep an eye on. So the next thing I like to look at is the dividend, and they've actually got a 50% payout ratio, which I'm not a fan of, because not only have they been raising debt and diluting shareholders, but they've also been paying out a dividend. So since they've got good return on invested capital metrics, and there's a lot of opportunities, that dividend, I think, should be cut, should be scrapped essentially. Use that money to pay down some of the debt. Use that cash to put into the deals so they can grow further, rather than taking money out of the business. So I don't think that's a good capital allocation policy. So I'm not a big fan of that. Now, last but definitely not least is incentives. Now, I like to see founder-led businesses. This is not a founder-led business anymore. Johnny, the CEO at the moment, he was headhunted. So his salary is over $4 million a year. That's a lot of that's in bonuses, and it's very corporate, typical corporate stuff going on there. And he hasn't built up anywhere near a large stake in the business. It doesn't look like the stock ownership that he has is anywhere near as much as his salary. So I think incentives are not actually quite aligned here. Okay, now turning to some positives. The growth opportunity, I think, for Diploma is still there. There's more geographic expansion through acquisitions. There's even a wider selection of products available for them to hold. There's more markets, more niches to serve. There's no issues with the runway here. And they're still pretty small, I think, in the big picture of things. Their market cap is sitting at around about 3 billion UK pound. Something that people bring up from time to time is that, well, Amazon could get into this game, but they're not really a large specialty distributor. It's not really what Amazon does. They're more B2C rather than B2B. I guess there's a possibility that something like this happens and could disrupt Diploma. But if it hasn't happened already, I'm not sure that Amazon are going to go down that path. I just think they're better. I think Amazon's more about the consumer. This is more business to business. Now, I have no idea what Amazon's plans are. I'm probably completely wrong here, but as a distributor, you'd have to think you've got, one eye over the shoulder looking back at Amazon potentially getting involved in the space. I don't know. Then there's another company called Grainger that, well, they don't offer the full range, but still a competitor, and they hold like the bestseller SKUs. It's a far bigger company than Diploma, and they could do something similar to Diploma, and they could change the competitive landscape if they were to hold more products, like more SKUs. The SKU is a stock keeping unit, like one particular thing, and there's tens of thousands of these little things that Diploma are holding. So Diploma have a bigger range, Grainger have more the top selling SKUs, but they could easily, copy Diploma. Now, something that I think Diploma have a good competitive advantage against the Graingers and the other small distributors is that they offer information as part of their service. Now, that's a pretty big advantage. You can't just call up Amazon and talk about the particular part or the seal or how it works or whatever, but you can with Diploma. You can call them up and ask specific questions about that particular product, which is pretty incredible. And that's a simple yet powerful advantage that they have. I hope you are enjoying this Diploma breakdown. In the next video, we're going to get into the valuation and do my summary, so stay tuned for that. If you haven't left a comment yet about Diploma and what I'm missing in this one, please do so. I'm happy for you to pull this idea apart on me, or even think that I'm being too negative or whatever it is. Please leave comments below. I read them all. It's very interesting. Hope you're enjoying, and I'll see you in the next one.